All right. Good Thursday afternoon, investors and traders, and welcome to Phenom Group's weekly State of the Market with your host, Seth Golden, who is on vacation, but um, the show must go on, as they say. And with that being said, today I think it's appropriate to talk a bit about where we are in terms of the bull market cycle. I've been emphasizing that we've been transitioning from an early stage bull market to a mid-cycle bull market. And we are firmly in a mid-cycle bull market at this time. You'll see as we progress through this week's state of the market, a lot of the trappings of a bull market, of a mid-cycle bull market, are present, which helps us to validate, where we are in the cycle, as well as how to position, and helps us to understand what we should expect from the markets going forward. It doesn't mean the market always delivers on our expectations, but at least we need to have some semblance of an understanding of what's probabilistic going forward. With that, we always need to recognize where most of our time needs to be spent as an investor or trader. Most of our time, as shown here, needs to be spent being patient and managing our emotions, making sure our emotional stability, our trader psychology is on sound footing, found for equilibrium day in and day out. Most of your time is spent being patient, managing emotions, as this pyramid structure shows you. Risk management comes thereafter, and risk management is largely about position sizing. You can cure almost all that ails your portfolio by strategically and tactically executing position sizes that are consistent with your risk tolerance. What's your risk tolerance? Well, you'll find that out in time, especially if you're a new investor and trader. But over time and with experience, you'll realize what position size works, such that it doesn't impact your sleeping habits, and you're not up at 4 o'clock in the morning checking futures and things of that sort. And lastly, technical analysis. In my opinion, technical analysis is just one of those three disciplines that you'll be focusing on day in and day out. The three disciplines that I often refer to are technical analysis, fundamental analysis, and quantitative analysis. All right, moving on. I saw this quote from Denzel Washington this week, and I love it. Because it coincides with what we've seen happen in the market since the pandemic lows of 2020, March 2020. So ease is a greater threat to progress than hardship. How does that relate to us as investors or traders? Well, things were pretty easy since the March lows, right? We hit the bottom, and from April, through the present period, it just really hasn't been that difficult. And for a lot of new traders, folks that just started investing in late 2020 and this year even, that ease for which gains and capital returns have come is not necessarily a good thing. You can get lulled to sleep from the ease that has been these markets over the last 20 months or so. And I think that's what Denzel Washington is hinting at. Ease is a greater threat to your portfolio than hardship. Through hardship, you learn, that discipline is necessary. You learn to what risk actually is, and what risk should be taken versus what risk shouldn't be taken. You learn how to manage risk. You learn how to manage your emotions. But when things are easy, especially from the get-go, you don't necessarily know if you are developing a skill set. A lot of it can be luck, especially in the early stage bull market, the early innings bull market. So that's how that quote, I think, best relates to us as investors and traders. This chart right here, since we are in December, what should we expect? Well, December is kind of starting out the way that, the seasonal patterns usually do. This is a 21-year chart of the major averages and how they trade on each trading day in December. And we're right here, folks, where we usually start to lift off. The early portion of December, you start out well, but then you chop around and even take a little bit of a dip. And we have up until yesterday, where we did lift off after the Fed meeting, but we're seeing a reversal of that here today. And unfortunately, some of the worst trading days of the year actually happened during our State of the Market video recordings. Not all of them, but some of them. All right, so with that being said, again, this is just these are seasonal tendencies going back to 2000. This is quantitative data from a seasonal perspective. As I often say, seasonality should be paired with other quantitative data. It shouldn't be standalone. On any given year, we can deviate from the seasonal trends. It's just a baseline expectation. All right, what about new highs? Right? Well, what about new highs for the year? We had a new closing high as of last Friday, but not a new all-time high in the S&P 500, which was 47.43, early November. So this study right here, this quantitative data right here, the last 10 sessions of December are bullish for the S&P 500. You can see the first 10 days, the average return rather, meager. Median returns a bit better, but the last 10 days, a lot better. And the percentage of the time the S&P 500 is up the last 10 days jumps to 72% of the time, which again coincides with the seasonal data where you tend to lift off. So there's a better possibility that we'll make a new all-time high, in the final trading days of December. So again, just some nice quantitative data there. January too, January's in here. The first 10 days of January tend to be pretty good, right? That's the back end of the Santa Claus rally. The Santa Claus rally being the final 3 trading days of December, the first 2 trading days of January. So not too bad. Average return, which is about 0.75%, up 64% of the time. The last 10 days of January, and only up 57%. It's like a coin flip, right? Okay, fast forward, some more quantitative data. This here from LPL Research. The S&P 500 gained greater than 3.8% last week, folks. I think we were up 3.6% last week in the Nasdaq. The Russell was up about 2.5%, speaking of small caps, which we haven't mentioned yet. And quite frankly, that's purposeful. It's crap. Stay away from it going forward. It doesn't mean it won't bounce. It don't mean you can't make a good trade, but you don't want to be parking your investment dollars in small caps going forward, in my opinion. Historically, that is not what works best in the mid-cycle bull market. So we were up 3.8% last week in the S&P 500. The previous 25 times it did that, meaning up, sharply for the week, 3.8% or better. It's happened 25 times before, the weekly gain. Going back to March of 2009, this study goes back to March 2009. 3 months later, it was higher 23 of the 25 times. 3 months later. 1 month later is pretty good too. Average return, 2.6%. Percent of the time it's positive. 1 month later, 76% of the time. So 3/4 of the time, 1 month later, after a big weekly gain like that, the market is positive. So having a bad week. Today's another bad day for the market. Yesterday could have been a head fake. You never know. I actually think it was more to do with fund flows, but again, we'll get to that. But this is about setting, expectations going forward. Big up week. 1 month later, the percent positivity rate is very strong. 3 months later, even stronger with even greater returns. 3 months. Why does that say 3 months and this says 3 months? What are they doing to me here? I think that's not supposed to be there. It must be this column because it said 23 out of 25 times. Either way, 84% positivity rate or 92% positivity rate. More often than not, it's higher. All right, let's fine tune things though, okay? So this is just any time you've had a big weekly gain since 2009. But what about if that big weekly surge leaves you just shy of the all-time high, shy of the previous peak after a big weekly surge? The next week, and we were at an all-time high actually, closing. This is on a closing basis. So on a closing basis, we closed at an all-time high last Friday, 47.12. When you have a big weekly surge and you close at an all-time high, 4 weeks later, not that great. 0.3% gain for the S&P 500, and it's a coin flip. 8 weeks later, again, 0.5. That's 2 months. 2 months, the S&P 500 is basically flat. And again, coin flip. You're in the 50 percentile positivity rate. 13 weeks later, it's better. You know, we're talking 3 months later. Returns 3.5%. The percent positivity gets that much better. So we shall see. But all-time highs are meaningful when you're thinking about forward returns, obviously, even after big surges. So we won't know which plays out, this one or this one. But seeing how it did leave us at a new all-time high, I think this is the study that we really need to hone in on. So, and we have chopped around this week, and we're going nowhere. So, all right, Bank of America, private clients have been selling, which is typical, you know, for them at this time of year. It's tax loss harvesting. Typically, December has been the month of peak selling by Bank of America private clients, suggesting sales by this group could accelerate over the next few weeks. I've never found any actionable, you know, value in the Bank of America data, quite frankly. But I thought it was notable. We talked about this. This is also a study from Larry Williams. TDLIM stands for Trading Days Left in the Month. It's Larry Williams, Trading Days Left in the Month for the month of December. And when you have 7 days left in the month, if you bought on the open and sold the next day, 95% of the time, going back to 2000 or 23 years, 22 years, the market has been higher. 95% of those years. So it's 23 times, 22 times you had a positive return if you bought on with only 7 days left and you sold the next day. Thinking of the spiders, the SPY ETF, if you had bought it with only 7 trading days left in December, sold it the next morning, 95% of the years going back 23 times, 23 years, you had a positive return. It's not that bad on, you know, with only 6 days left, with only 5 days left, with only 4 days left, it's 95% also. It's quantitative data. When we invest, we lean into the probabilities. Anything is possible in the market. When somebody says, well, anything is, but no crap. That doesn't help me. What I need is the probabilities as an investor and trader. The more often you lean into the probabilities, the more often it's going to work out in your favor. And by the way, I think it's December 23rd would be the start date, or, you know, that 7 day there, I think. Double check, you know, holidays and things like that may play a role because we're closed Christmas Day. The markets are closed, obviously. Markets are open Christmas Eve. Markets are open the day after Christmas if it's not a weekend, obviously, but, you know, check your calendar. All right, here's another interesting quantitative study here. Last week's new closing high on the S&P 500 was 47.13. It was accompanied by more new lows than new highs on the NYSE, though. We had many more stocks that were making new lows as the S&P 500 was making a closing high than stocks that were actually making highs along with the index. And this was the first time this has happened in about 3 years, a little more than 3 years. In the past, the market hasn't tended to celebrate this sort of breadth divergence. So you have the index going up, but there's a lot of stocks making new lows while that's happening. Now, we know that the indexes are cap weighted. So it's very probable that markets, as long as the larger cap weighted stocks are moving up, they can take the index with them. But a lot of the small caps and a lot of the micro caps and even the mid caps were making new lows. And again, this has happened, a great many times here. As you can see, the sample study goes back to 1951. But when this happens, based on what we're studying here, the index making a new closing high, but many new lows in the NYSE, 4 weeks later, the median return is negative. 8 weeks later, again, market's not really liking this. Gets better the further you go out in time. 13 weeks later, the market is delivering a 1.8% return. And again, 26 weeks, 52 weeks, things are much better. But, just like the former study here, you might expect some choppiness in the 4 and 8 week time period. This also suggests that what's going on underneath the surface of the market is not supportive of sustaining new highs. Things have to change. Buyers need to come in. Maybe they will. Let's see if any of these, right here. This is December, obviously, 1999. But indeed, big losses. I'm looking for December's because seasonality does play a big part. Yeah, see, here's 1963 where the 4 week return was still strong. 1963, good year. 1999, not so much. So even there, if we're looking at December, this occurrence during the month of December doesn't give us much of an edge, unfortunately. Trying to break things down. All right, coming into this week, we knew that there was a high probability that the market could weaken because, well, we were 2 standard deviations above the 50-day moving average that you see here in green. Usually when you get 2 standard deviations or better above the 50-day moving average, you get some type of price consolidation. Happens almost every single time. You don't know when. You can have a period where you keep trending higher, but ultimately you will consolidate. Sometimes it happens faster. Sometimes it takes longer. Faster. This one took a bit of time here. And we're already consolidating the gains from last week, obviously, this week. What also you can see here is that if we look at the 5-day RSI during last week's move, it wasn't nearly, we didn't get nearly as overbought. The relative strength wasn't quite as strong during this run here as we saw last week. So that's a bit of a relative strength breadth divergence, obviously. So there was a couple of signs that suggested, indeed, we should anticipate some type of consolidation near term. We didn't know that it would happen this week. We don't need to know exactly when it happens. We just need to be able to anticipate it so that when it does happen, we're not caught off guard. This is part of our plan. We know this is normal and to be expected from the indices given the conditions. All right, as I said earlier about fund flows and maybe yesterday's price action being nothing more than a exercise in fund flows. So on Monday, we had that big drop in the S&P 500, but as this chart shows, this is a chart of fund flows into the SPDR ETF, SPY, the index ETF for the S&P 500, saw $6 billion worth of inflows as the index, the S&P 500 and SPDR were basically tanking. And it's very probable that these found a home yesterday through the FOMC meeting. These fund flows found their necessary, completion. And it's probably why we saw the market accelerate through the chairman's press conference. All right. Now, while we have rough markets here this week, and mostly, the Nasdaq is the outperformer to the downside here, it is important to remember where we came from. We had a bit of a breath thrust here recently. We went from oversold to overbought rather quickly. Last week, during the S&P 500's gain of 3.8% on the week, the number of S&P 500 members above their 10-day moving average increased from 5% down here to 89% up here. This signal triggered 52 times over the last 93 years. That's why I say it's a breath thrust. We had extremely poor breath measured by the number of stocks, or the percentage of stocks trading above their 10-day moving average being this low, and cycling to the percentage of stocks trading above their 10-day moving average being this high. So that's why we call it a breath thrust. All of a sudden, the buyers just forced the market higher there. So this has happened 52 times over the last 93 years. After the others, future returns and the positivity rate were solid across all time frames, meaning they're above 60% over the next month, 3 months, 6 months, and 12-month time periods. Doesn't mean all of them were, just means the majority were. Here's kind of a picture of that thrust. Today's 85%, this was on the 7th, December 7th. Today's 85% upside day. Upside is upside volume moving higher as opposed to declining volume. Upside day means we have now had back-to-back 80% upside days. So 2 days in a row, December 6th and December 7th, where the volume in the NYSE was up 80% or greater. When that happens, that's another, type of breath thrust. So last week, volume in advancing securities on the NYSE totaled 80% or more total volume on December 7th, and it triggered a signal that has an undefeated, meaning it's never been wrong, undefeated track record of gains historically. The signal is triggered when there are 2 consecutive days of 80% or greater advancing volume. The S&P 500 averaged a gain of greater than 25% within the next year. So it's got 100%, positivity rate. It's never been defeated. Doesn't mean we're going to get a greater than 25% return. No, it just means that was the average. That was the average based on the times that these have, this breath thrust has triggered. We haven't had a 10% correction in the S&P 500 now in 425 trading days, folks. This chart right here, basically expresses that in a secular bull market, which we are in, we're in a secular bull market. Secular bull markets can last anywhere from 10 to 15 years. Within secular bull markets, you can have cyclical bear markets and cyclical bull markets, which are shorter in duration. Nonetheless, when you're in a secular bull market, you typically have, on average, a 10% correction every 331 trading days. I just said we have gone 425 trading days without a 10% correction. So should we anticipate a 10% correction in the near future? I would think so. Are you of the opinion that we're going to go through all of 2022 without a 10% correction? That would be 2 consecutive years? I think it's happened before. Don't get me wrong. It has happened before. But is that the greater probability? Again, it's all about setting reasonable expectations as an investor so that you can formulate an actionable game plan that is conducive to achieving your annual return goals. 331 days, we usually have a 10% correction. We're now 425 days in. This chart right here shows you, this goes back to 1980. These are your drawdowns in red at the bottom, the annual drawdown. So indeed, you know, here in, I think that's 04, 05, 06, 3 years in a row without a 10% correction on a closing basis. Here, look at all these, no 10% correction. Looks like that's 93, 94, 95, 96. It can happen for many years, apparently. But if you total all the drawdowns since 1980, the average annual drawdown is 14.3%. That's the average. You know, some years it's 30, 34, 20, 34, 49, 34. Some days, some years, it's as little as 3%. This year, so far, 5%. But when people say the market is due, nah, don't do that to yourself. Market is not on a schedule. It doesn't punch in and punch out. You know, it's not an employee. Market is not, doesn't have an expiration date or a due date. We look at the averages. We look at the probabilities, and that's what all of this data helps us to discern. What are the probabilities of a 10% correction? Now, that's the S&P 500. What about the Russell, right? I said I didn't want to talk about small caps, but we need to. Since 1979, the small cap Russell 2000 expressed more frequent drawdowns than its large cap cousin, the S&P 500. 5% drawdowns. Again, this is going back to 1979, almost 4 a year. S&P 500, just about 3. 10% drawdowns, 1.3 times a year. S&P 500, not even 1. And 15% and 20%. Bottom line is, you got a lot more volatility in the Russell, and you usually have larger drawdowns more frequently in the Russell. Do you want to be in small caps during the mid-cycle bull market, knowing this? So small caps, I don't like for the mid-cycle. I also think you gotta get the garbage out of your portfolio. The things that work in the early innings of a bull market are not the things that will work for your portfolio in the mid-cycle or late-cycle bull market. This chart right here informs us of what has been discarded throughout this year. Non-profitable tech, pretty much at the lows of the year. SPACs, pretty much at the low of the year. And then you have some sentiment indicators, which are poor right now. And the most shorted stocks in the market have done better than SPACs and better than non-profitable tech. What are we talking about here? Companies that don't have earnings. They're not going to do well in a mid-cycle bull market. Oh, you like DraftKings because it's a big name, and Snow, and you know, Virgin Galactic and GameStop and AMC. Trust me, folks, it was fun while it lasted. This is not an accident here. This is what happens when you transition from the early stage bull market to the mid-cycle. This is DraftKings. Oh, I'm buying it cheap. It used to be. It doesn't mean it's going back there. It's not about where it came from. It's about where it's going. Do the earnings, do the sales, does the market share, does the moat around its business model support a turnaround and a new all-time high? If the answer to those questions are, I don't know, don't touch it. If the answers to those questions are no, don't touch it. Move on to something else. Parabolic moves like this after an IPO are not survivable. It's just another demonstration. Stay away from unprofitable tech, SPACs, small caps, micro caps. These are not going to do you a good service during the mid-cycle bull market, folks. All right, coming into today, folks, we had an inverse head and shoulder going on. And if it were If we were to find the S&P 500 close above this neckline here, which would come about 47.15, there's a high probability that we would continue with a new leg of the bull market rally. And if that were to happen, close around 47.15, a new closing high, you take the measured move here from the inverse head to the shoulder, and it's about 200 points. So we could potentially, for the new leg of this bull market rally, be looking at 4,900 or so on the S&P 500. Again, still need to close above 47.15 to get that continuation pattern as it's known. If we don't, inverse head and shoulders pattern is not proven favorable and it's not a continuation pattern. We're still in this realm where the setup, remain cautiously optimistic. All right, price targets for the S&P 500, they've been coming out slowly from the different institutions over the last couple of weeks. They're 2022 price targets. The high on the street now is Jonathan Stoltzfus from Oppenheimer at 53.30. Here's all of his notes, his rationale for his price target, but he's the high on the street now at 53.30. Here's all the other price targets that I have: Barclays, JP Morgan, Bank of America, Jefferies, BNP Paribas, so on and so forth. So check them out at your leisure. I think the average price target amongst those that have given them so far is about 5,050 for the S&P 500. So we'll see. Now, as I said earlier, the Nasdaq has been taking the bigger drawdowns on an intraday basis here this week. As I said before, unprofitable tech, that's like getting the, hit the most. People are cleansing their portfolios of the garbage, the stuff that just doesn't work in a mid-cycle. Well, Nasdaq has a lot of garbage, folks. It's a growth index, but it's so heavily weighted atop. The top 9 stocks in the Nasdaq make up 50% of the index. 50%. And the next 10 stocks make up about another 10% of the index. The problem right now is it's not just the garbage that's getting hit. You had a really big surge in large cap growth, large cap tech, Apple, Microsoft, but now people are taking profits there. At the same time, they're deleveraging all the garbage, the unprofitable tech, the small caps within the Nasdaq. And so we're getting, the percent of stocks that are trading above their 200-day moving average. That's what this chart is. The percentage of stocks trading above their 200-day moving average in the Nasdaq as of just a couple days ago on the 13th was just 27%. Only 27% of Nasdaq stocks were trading above their long-term 200-day moving average, which is not a good sign. Almost every single time we've gotten this low in this breadth reading, or lower obviously, we've had a full correction in the Nasdaq. We're not talking about the S&P, we're talking about the Nasdaq here. Just the other day, it was down about 7% before the reversal on Wednesday during the Fed meeting. It got down 7%. But every time, and that's what these arrows indicate, going back to 2010, every time we got to this level, we had a full 10% or greater correction in the Nasdaq. I'm not trying to scare you folks. It's about knowing what to expect so you can anticipate and game plan. So if the Nasdaq falls 10% or greater, it's supposed to, because breadth is so poor in the index. The only way it could exonerate it is if those large cap stocks within the index catch a significant bid once again, as they had in the previous week. Here's all the charts from the individual years. In 2010, as you can see here, breadth was that bad. We had a 19% correction. 4 months it was in correction territory for 4 months. It was the longest. 2011, 4 months, 19% again. 2014, we had a 12% correction. There it is, 2014, 12% correction. Guess what? 4 days. That's it. It was down 10% from the peak for just 4 days before it rebounded and made new highs. 4 months, 4 trading days, folks. 2015, we had a 16% correction, 33 days. Not that long. 2015, another 19% correction, 36 days in correction territory. 2018, 21% intraday peak to trough correction, 55 days in correction territory, just over 3 months. So what does this tell? Why am I, going through the actual trade? Because you don't know if it's going to be 4 days or 4 months, 30 days, or the bottom line is you're getting better prices. Are your 4 buy the dip indicators suggesting that you should still buy the dip in the Nasdaq? The same way we would ask is if it was happening in the S&P 500. Is the yield curve inverted? If the answer is no, buy the dip in the Nasdaq. Are credit spreads blowing out? If the answer is no, buy the dip in the Nasdaq. Are earnings still growing? If the answer is yes, buy the dip in the Nasdaq. We're down 5%, buy some. 10%, buy some more. 15%, buy some more. Roughly 20%, buy some more. Because eventually, we good? It's not something to be afraid. It's something to anticipate and even be optimistic about. Maybe you didn't market perform this year. The S&P 500 is up 25%. The Nasdaq was up 22%. Maybe you only gained 5-10% on the year. Better prices are your opportunity to leverage, assuming you know the buy the dip indicators. It's something to be grateful for when price gets cheap. Do not run away from a sale. All right, we talked about breadth in the Nasdaq. That's what we were looking at, the percentage of stocks trading above their 200-day moving average. The average stock distance in the Nasdaq, in the S&P 500, in the mid caps and in the small caps. The average stock, drawdown from their 52-week high in the Nasdaq, it's 39%. The average stock is down 39% from its high. The Nasdaq 100, which is, the Qs, if you will, only 16.6%, because that's the best of the best in the Nasdaq. The S&P 500, the average stock in the S&P 500 is down almost 12%. Mid caps are down more, and small caps are down even more. That's why I say, don't bother with the small caps. Everybody knows it. Don't be the last person to find out that you do not want to be, investing in small caps going forward. I'm not saying you can't get a return. I'm saying you'll probably get a better return out of large caps. Breadth is good to know. You want to know the market internals, market breadth. And the Nasdaq, again, the Nasdaq is so heavily weighted at the top, more so than the S&P 500. The top 10 stocks in the S&P 500 only make up about 23-24% of the index. As I said before, the top 9 stocks in the Nasdaq make up 50% of the index. So when you look at the advanced decline line in the Nasdaq, this is what it looks like, folks. This goes all the way back to 1983. It's a good reminder that the advanced decline line for the Nasdaq can be deceptively bearish, right? You look at this and you're like, I do not want to buy the Nasdaq. But keep in mind, there are a lot of fallen angels in the Nasdaq. A lot of unprofitable tech over the years, SPACs now, that just don't make it. They get delisted every year. Since 1979, regardless of this going on in the advanced decline line for the Nasdaq, it is up 13,164%, while the advanced decline line is down 73%. So, breath schmeck, right? All right. While everybody is so fixated on rates, and they were so afraid that the Fed is going to be more hawkish and rates being raise 2 times or 3 times or 4 times. Look, rates are not your biggest issue going into next year. The fact that the Fed would feel comfortable raising rates next year tells you that the economy is strong enough to support higher rates. Earnings are growing, which, to support this move by the Federal Reserve. Your biggest obstacle next year, or maybe a bigger obstacle than rates next year, is that it's year 2 of the presidential cycle, which is historically the weakest of a 4-year presidential cycle. As you can see here, the positivity rate is only up 55% of the time in year 2 of a presidential cycle. The average return, 6%. This goes back to 1950. What else? Whoops. Under a new president, stocks underperformed early, but improved later in year 2. Be aware, the calendar isn't doing anyone favors the next few quarters. It's all based on year 2 of a presidential cycle. Because what happens in year 2 of a presidential cycle? You have midterm elections. And during midterm, this is any year. This is just all other years except for a midterm election year. The top line here shows you most years, smooth sailing to the upside. January, and you get a nice, Santa Claus rally at the end of the year. You get some turbulence around September, which is typical. But then you surge again. However, in a midterm election year, you chop around in the beginning. You get that April, which is one of the best months of the year for the markets. But then you get the sell in May, and you get a lot of chop, even declines on the year during a midterm election year. But then when you actually get the election results, we're off to the races. But that's a lot of time that you lose consolidating the index price. It doesn't leave much time for advancement in the back half of the year or the final quarter of the year. This is your obstacle, folks. It's not rates. It really is not rates. And when we speak of corrections, because everybody seems to always anticipate the correction and position just in case, remember this saying when it comes to positioning for a correction. Nobody knows when the correction is going to happen. And more money has been lost preparing for a correction than in the correction itself. That quote is from Peter Lynch, one of the most famous investors of all time. But if you had invested with Peter Lynch, you really had to nail it right. You had to be in his fund before it took off. Kind of like Cathie Woods. You had to be in it before she became as popular as she has become since the pandemic. But again, rates, okay? This study right here, this is the last 7 Fed tightening cycles where they're raising rates. The S&P 500, 3 months before was nicely positive. 3 months after the first rate hike, basically flat. 6 months later, nice returns on average, 6.5% over 6 months. That's 1% every month. You're not getting that in your savings account. You're not getting that in the bond market. 12 months later, the market is up almost 11%. Remember, the Fed feels comfortable hiking rates because the economy is doing good. If the economy is doing good, earnings are improving. They're growing. If earnings are growing, the market is fine. It's going to take care of itself. It may have schisms here and there, but that's normal and to be expected. The market will climb the wall of worry over time. You just have to give it time. But as this study shows, rates are not your end. Hiking rates, a Fed tightening cycle, it's mostly CNBC and Bloomberg. Just how do we fill up production time? How do we fill up airtime day in and day out? I mentioned Cathie Woods and ARK Invest. Amy Arnott at Morningstar. She wrote an excellent piece called ARK, an object lesson in how not to invest. And the chart shows the monthly flows in to the ARK ETF. This is 2020. You can see all the flows into the ETF through December there. now, because that's what, let's see here, this chart right now, the bottom line, because so much money came in after. It came after the insane run in the fund. The difference between fund returns and investor returns are not pretty. Over the last year, ARK is down 4.3%, not year to date, over the last 52 weeks. The ARK is down 4.3%, but the average dollar invested in the fund over the last year is down 12%. If you zoom out, the numbers get considerably worse, folks. The bottom line is, by the time you hear about the hottest fund manager, the best of their performance has already happened. And that type of outperformance is unlikely to be sustained. It happened with, some of the best fund managers over the years. Jerry Tsai, he was basically the first star fund manager in the go-go years of the 1960s. But you had to get into his fund before he became a star. Otherwise, you didn't do very well. Here's Peter Lynch, same situation. Like, all of these folks had, great reputations, but you had to be in there before they became, the next great fund manager. Otherwise, you were too late, and their performance just wasn't sustainable. And here's the ARK ETF. Well, this is actually the Berkshire Hathaway stock. And this is the ARK ETF. What did I say about parabolic moves earlier today? They're not survivable. I've never seen one that was survivable. It doesn't mean that I'm saying the stock can't go back to its all-time highs. It means that there's going to be ample human behavior that takes place before it does so. What is that human behavior? Profit taking. Profit taking, deleveraging. So this is the ARK ETF. This is Berkshire Hathaway. Slow, steady. Even during slow and steady, you get consolidation, but you don't get this kind of consolidation. Well, Warren Buffett, he's a great investor, but even Warren Buffett suffers. Warren, this is his track record over the last 1 year, and this is the S&P 500. So he underperformed the 1-year return of the S&P 500, the 5-year return of the S&P 500, and he underperformed the 10-year return of the S&P 500. 20 years though, he's still slightly outperforming. He hasn't done a lot lately, that's for sure. All right, folks, keep a level head as we go into the end of the year. Look at your game plan. Look at what's in your portfolio. Make sure that's the stuff you want in there. Signing off. I'll see you guys next week.